Welcome to the latest in conversation. My name is Pierre Braun, Senior Investment Analyst at Pitcher Partners Investment Services. Joining me today is Theodore Calligaris, Portfolio Manager at Realm Investment House. Theodore manages the Realm Strategic Income Fund, which specializes in investing in asset-backed securities. Theodore is coming to give us some insights on this specialized form of investing and give us his thoughts on the market conditions. For someone who is new to investing in asset-backed securities, could you quickly describe how it works?
Sure. So asset-backed securities, as the name implies, effectively what they are is securities where you're backing it with an asset. Now, if you think about what a bond is typically just a loan. That loan is usually secured against the strength of the balance sheet of the bank or the corporate entity that's offering it. Now, when you're looking at a consumer, which is who you're lending to in a lot of asset-backed securities, the consumer doesn't have a large amount of balance sheet strength. So what you're going to do instead is you're going to take security or charge over collateral. Now, the collateral is just going to be houses or autos or whatever other assets that you end up lending for. For our purposes, generally it's going to be houses. So effectively you lend to the consumer and you take security over the property that they are lending for. So if the consumer ever doesn't feel their obligations to service their loan, we're going to take over that particular mortgage or that particular house and foreclose on that property so that we can get our money back.
Can you elaborate on the investment process? What factors do you consider when selecting issuers?
So Realm aims to partner with major banks to provide these lending facilities to your strongest non-bank lenders in the Australian market. Our focus is really on just providing really good quality lending programs from those good lenders. That's all we want to do. Now, it's quite interesting when you're looking at what makes up a good quality lend, the biggest typical marker that you're going to see is track record. You're going to have seen these lenders play in their niche for quite some time. They're going to understand exactly what kind of risk they want to write and have a really long demonstrable track record of writing these particular loans for that period of time. The other thing that's always really important in this part of the market is not just the track record, but also the ability to do it sustainably as well. So you'll see a lot of weaker players in the market starting to come in with no balance sheet support. Now, not having balance sheet support effectively leads you to pushing the boundaries a little bit in what you can and can't write. So that's not what you want to see. So for Realm, we'll focus on both the lending program and also the lender who's doing the lending program as well. You want to see that equally are very strong.
Can you give us an overview of the performance and positioning of the fund so far?
So I'll start with fund positioning. So for the fund positioning, about 70% of the fund will sit in these private facilities or what we call warehouses. Now, effectively all a warehouse is, before you can sell out 1,000 loans to market, you need to first go and write 1,000 new loans. So what Realm does is it provides lenders with the lending criteria to go out and lend. Now, effectively, we can charge for that. So you get paid a decent premium over public markets. To give a sense of the quantum of that premium, if you're buying a typical bank bond in the Australian market today with a BBB rating, generally you're looking at about BBSW plus 2.5%. If you're looking at structured assets, effectively structured credit, BBB, you're probably getting paid closer to about 4.5% over BBSW. If you're coming into the private market for exactly the same credit rating, exactly that same investment grade BBB rating, you're probably getting paid closer to about 6.8% at the moment. So the yield pickup for taking exactly the same BBB rated risk is quite substantial in private markets, which is one of the reasons that we really like the space. When you begin to combine that with the idea that you are setting the lending criteria and you are deciding what risk is and is not allowable in these programs, you are not only setting the risk, but you're also setting the return level that you're getting paid, which is one of the reasons it appears as quite a strong relative value trade for us.
Can you elaborate on the protection investors have if a borrower defaults?
So there's a few main sources of protection that come into these bonds. I think there's three main ones that we'll touch on there. The first of which is the security that you're taking over the asset. So if I'm lending to people for the purposes of purchasing a house, and that house has a 60% loan to value ratio, my first protection is always going to be the security of that house or the equity that's built up in that particular loan. If that borrower defaults, I'm going to go and sell that particular property and recoup all of my money, given that the loan to value ratio is so small. So that's always something that you want to look at. You want to look at exactly how low your loan to value ratios are and exactly how secured you are against each of these underlying properties. The second comes in the form of structuring. Whenever we make one of these loans to one of these issuers, what we're always going to look for is that issuer to put their own capital below us. So effectively that serves two purposes. The first of which is if anything ever goes wrong in the trust, it is the issuer who is losing their money first. So it is always that first stage of protection in any trust. The second is alignment. The issuer understands that it is their capital that's getting lost first. So they're very focused on aligning the interest of you and them by only writing good quality risk. They're not writing poor quality risk if they know there is a chance that they can lose money. The third comes in the form of what profits are being made by those particular trusts as well. Now, within the Australian market, effectively you've got minimum profit requirements on a lot of these trusts. So if I'm writing mortgages for 6.5% and it's only costing me about 5.7% to fund these particular mortgages, I'm making about 0.8% of profit. If anything is ever to happen to, or within the trust, if there are any losses that come through the trust, the first point of call is to reduce the profit until that profit is reduced completely. Now, there is an Australian mechanism as well called a threshold rate, which means a trust cannot make less than 25 basis points worth of profit. So you've always got that protection that sits there, and that is always your first point of protection in a lot of these structures as well.
Could you give us some insights on the arrears in the portfolio and how did you compare them to the banks or the index?
So within the Australian market, generally S&P publish an arrears index. They call it the S&P Performance Index or SPIN. So SPIN for prime loans, so good quality loans that would otherwise go to a bank or are in banks for the most part. Generally at the moment they're tracking at about 0.93%. They've been as low as about 0.6% in October of last year. They've now come up closer to their 5-year historic average of about 1%. So they're tracking quite well in this part of the market. In the non-conforming side of the market, arrears sit a little bit higher because the lends are a little bit less quality. So you're looking at people who are more self-employed, more investor-based. They've got alternative forms of documentation rather than full forms of documentation. Effectively, arrears in this part of the market sit closer to about 3.6% at the moment. Usually the 5-year historic average for these kinds of loans is closer to about 5%. So you're still well under your 5-year historic average. The performance of the fund at the moment sitting closer to about 1.39%. So given the mix of prime and non-conforming that we have, we're very happy with how the fund is positioned at the moment. And you can see exactly what part of the market that you're taking risk in. Now, I think the most important part of that as well is when you're starting to look at the arrears rate, you want to actually look further than that and you want to find out not only what the arrears are, but where arrears may become a problem. So in every single one of our documents, we also install arrears triggers. If arrears go above a certain point, that particular lender is no longer able to utilize that facility to do new lending. So effectively, it's always going to be in their best interest to assist us in maintaining that arrears rate at a decent level.
Given the private nature of the holdings, how do you manage liquidity in the fund?
So this is a fantastic question in that what this fund is not, is it is not a direct mortgage fund. So what we've done is structure it completely against that. We've seen how direct mortgage funds have performed in different environments. It's not what we like to find ourselves in. So effectively, when you're looking at a direct mortgage fund, what you are funding is you're giving up short-term assets, so capital for the space of 6 months to a year, and you are funding long-term liabilities, which might be 30-year mortgages. So in that instance, effectively, you've got quite a large asset liability mismatch. You've got short-term capital and long-term money. So if anything is ever to go wrong, you're waiting for that long-term capital to completely pay down over time. Now, in this particular fund, what you're actually funding is you are funding non-bank lenders such that they can go out and lend capital. Those agreements are only for the space of a year. So what you find is the fund's credit duration is actually quite short. It's not 30 years like the underlying assets. It's actually closer to about 0.8 years at the moment. So effectively what that means is if there is ever an issue, the liquidity of the fund comes through 3 main sources. The first is the cash, which there is always about 5% of cash that's sitting in the fund. The second is in public securities, which are freely tradable. Again, there is between about 15 and 20% of public securities at all time. And the remainder comes from warehouses or private facilities that are actually coming to the end of their life. So what you find is at the end of each of these facilities' lives, 3 months prior to the end, the issuer will give you a call and say, hey, we have this facility actually coming due. What would you like to do? Would you like to extend the facility for a further 12 months or would you like your capital back? If you elect to have your capital back, they will most likely sell that portfolio back into the public market and repay you your capital.
Can you talk about the outlook for the fund in terms of positioning and performance?
So the fund, in terms of positioning as a starting point, the fund will look very similar to what it does today. You're seeing the vast majority of relative value coming from that private part of the market, which is where the fund's focused. So you'll see the private allocation remaining there or thereabouts that 70 to 80% mark. You'll also see that portion of cash, that 5%, that will be held in the fund at all times as well. And you'll see a small balance of public securities drawn up or drawn down. Generally, we run that between 15 and 20%. Now, the most important thing about public securities, the reason we have that small buffer, is because when we are negotiating one of these new private facilities, it can take between 6 to 8 weeks to completely negotiate one of these facilities. So effectively what you're looking for in that situation is you're looking for some assets to put in the fund prior to the settlement of that new warehouse, which might happen in 2 months' time. So you've got quite a good line of sight on exactly what is coming down the fund and exactly what needs to be funded, but you do need assets in the meantime as well. So you're always going to run public securities as that buffer as well. So they're always going to be there to assist the liquidity purposes. Now, this fund is not a trading fund. It is not designed to be turned over rapidly. All it's designed to do is make good quality investments with good quality issuers and effectively live off the accrual of those particular investments. At the moment, the fund running yield sits at about 10.6%. We envisage that it stays there or thereabouts. Maybe it starts to come down as credit markets begin to perform slightly. Again, we would expect the strong accrual to be the vast majority of the return that you are seeing in this part of the market.
Thank you, Theodore, for joining us, and thank you for sharing your insights today.
Pleasure.
Thank you for joining us today. Please remember to check the website and other videos on YouTube, LinkedIn, and please talk to us if you have any questions. Thank you.